Carnival's got a pretty wild backstory with massive debt, insane growth potential, and all the twists and turns that make it a high risk, high reward play. Oh, and stick around because at the end, I'm going to reveal my growth value risk score for this stock, where we break down the growth value and risk levels. And trust me, the results might surprise you. Now, first off, cruise stocks in general have been kind of wild, but Carnival is actually sitting in a pretty decent spot right now. There's this whole risk reward balance going on, and it's leaning towards the reward side right now. I mean, we're seeing strong demand for cruises, and that's really what keeps the momentum going for Carnival. People just want to cruise, man, and it's just as simple as that. And with the interest rate cuts, Carnival is going to benefit big time. Why? Because, like a lot of other cruise companies, they've got a pretty heavy debt load. But with rates coming down, their margins might start to look a lot healthier. Lower interest payments, more cash to work with, is just a better situation all around. Now, Carnival's Q3 earnings are coming up, and there's a lot of buzz about it. People are expecting some solid growth, mainly because of the insane demand for cruises right now. And Carnival, they've been working to expand those margins too. So it's looking like this could be a real turning point for them. I mean, the numbers are lining up for them. We're talking an 8% compound annual growth rate in sales through 2026 and about 16% in adjusted EBITDA. That's some solid growth potential. And even with all that debt hanging, there's a 17 to 18% potential upside. That's pretty good. Now we have to talk about the debt situation. There's no getting around it. They've got one of the biggest debt loads in the cruise industry, but they're managing it pretty well. Sure, the interest rates are high, but now that the Fed decided to cut interest rates, Carnival's going to be able to breathe a lot easier and essentially expand their margins. And speaking of margins, Carnival's sitting at an operating margin of about 12.1% and an adjusted EBITDA margin around 20%. Now, that's not as high as some of the other competitors like Royal Caribbean, but it's improving. And really, when you've got debt that big, margin growth is the key to staying afloat. Now, let's talk about the cruise industry as a whole, just for 1 second. Things are looking pretty good for Carnival and their competitors. I mean, just look at the Royal Caribbean and Norwegian. They're crushing it right now with massive growth thanks to this huge demand for cruises. And Carnival, they're lagging behind a little bit, but they're catching up, especially when it comes to top line growth. They've got their Q3 earnings coming up at the end of September. And if the momentum in the industry is any indication, Carnival's going to have some pretty decent numbers to show. Plus, with the Federal Reserve cutting rates, Carnival is in a prime position to keep pushing forward. So let's talk about the valuation. Carnival is expected to hit that 8% sales growth through 2026, and their adjusted EBITDA is projected to grow 16% over the same period. Sure, their forward earnings multiple might be hovering around 30x, but their high interest expenses are bringing that down to something more like 6x. Even with all that, there's still a solid 17 to 18% upside potential in my opinion. It's a classic case of a company that's working through some challenges, but has the potential to come out stronger on the other side. And there's one thing that Carnival's doing right now, and that's their deleveraging plan. They got this big plan in place. They're looking to cut their debt by $10 billion by 2026. That's pretty huge. They're doing this by generating more cash flow and cutting down on their capital expenditures. Less money going to new ships and more towards paying off debt. If they stick to this plan, we could be looking at a pretty strong recovery by 2026. In fact, if we apply a historical PE ratio of 14 to their forecasted earnings in 2026, we're talking a potential share price of $30 a share. And right now the stock is sitting at around $16.50. So yeah, we're looking at the potential for the stock to double in a couple of years. That's a pretty compelling argument to get in now. Carnival's also got a plan to grow their earnings per share to $2.20 by 2026. And the big driver behind that is lowering those massive interest payments. They're forecasting that their interest expenses will drop from $2.1 billion in 2023 to $1.1 billion by 2026. That's a big difference, and it's going to help push those earnings higher. The company's working on improving their EBITDA, and they're forecasting $5.8 billion in 2024. Plus, they're benefiting from higher pricing and occupancy levels, so things are trending in the right direction. So what's my final thought? What's the takeaway here? Carnival's definitely got its challenges, but they've also got a pretty solid plan to get out from under the mountain of debt. The strong demand for the cruises isn't going anywhere, and with those interest rate cuts that just came through, Carnival's in a much better place. If you're looking for a stock with some upside potential and you're willing to take on a bit of a risk, Carnival's worth a look. They're set up for some solid growth around the next few years. And if they execute their reduction plan and interest rates fall, we could see some serious gains in the stock price. Now let's take a look at my GVR score for this, the growth value risk score. For growth, 8 out of 10. Carnival's revenue and earnings potential over the next few years looks strong, with an 8% compound annual growth in sales and a 16% adjusted EBITDA through 2026. As demand for cruises continue to rise, the company is in a good spot to benefit. Value is also 8 out of 10. Carnival's valuation is a bit tricky because of the high interest expenses, but with potential refinancing and interest rate cuts, there's room for improvement. Right now, the stock is trading at a relatively low forward earnings multiple, so there's still value to be unlocked, though it's not exactly cheap. As for risk, 7 out of 10. The biggest risk with Carnival is its massive debt load and reliance on the interest rate cuts. While the company's plan to reduce debt is promising, any unfavorable shifts in demand or anything else would derail them from recovery. All in all, that's a GVR score of 25 out of 30. Carnival represents a great investment. It has good growth prospects, good value, and a manageable risk portfolio, provided they stick to their deleveraging plan. If you're into cruise stocks or looking for a recovery play, keep your eyes on Carnival. There's definitely potential here, and it might just be smooth sailing ahead. Catch you in the next one.